Hi there, welcome to the second lesson, and this is on accounting equation. So the accounting equation is the very fundamental in POA in accounting, and the equation can be remembered through this acronym called ALO, which is aloe vera, if you like to. So what does ALO stand for? It stands for three of these elements that we talked about the last video, and we have A equals to L plus OE. So A, if you recall, is assets equals to liabilities plus O stands for owners, equity. So the last lesson or last video, we talked about equity, EQ as equity. And here I introduced to you the word owners equity because we are focusing mainly on sole proprietorship, meaning businesses that are owned by one person. So this is the interaction of the three elements. So why is this so? If you recall, in the last video, we talked about a business that required $3,000 to be set up, which is made up of $2,000 for the building and $1,000 for the roof. And if you recall, the money that the business gets from is from Mr. R, who was willing to invest $2,000. So he is the equity, he represents the equity, and the bank that was willing to lend just $1,000. So because they are these sources of income or not income, sources of money comes from two different people, two different entities, and we cannot classify them in the same elements. Therefore, that is why we break down the assets here into two different segments, which is a liability and owner's equity. So if a question asks you what is the accounting equation, then you will have to give this as the answer. This is what we typically call the basic accounting equation. If there's a basic, there will be an advanced, or rather a more expanded accounting equation. So if you recall in the previous video as well, we talk about businesses, usually typically you run it to get profits out of it. So investors usually invest some money in a business and expect to gain some profits out of it. So profits this only goes to the equity segment. So the only way, one way rather, that the equity can increase is when the profit is present. So if profit increase, then the equity will increase. Right, the banks will not take the profit usually. It is the owners or rather the investors who will take the profit home. So how do we increase the equity is through the profit. So if you were to expand it, if you recall that profit is made up of income minus expenses. So if I were to replace this, okay, or rather just expand it a little bit more. So over time, some profit is being gained, and we can further break down profit into this expanded equation, which is income minus expenses. So here, in fact, I introduced to you the 5 elements that we talked about in the previous video, whereby you have assets, liabilities, equity, income, and expenses. And here, we'll see that equity is actually made up of two very fundamental accounts. If you recall, Mr. R contributed $2,000 to the business. So there's this thing called the capital. So what the owner contributes into the business. So the 2,000 that Mr. R contributed, that is actually under the account called capital. And at the same time, if the owner can contribute, the owner also has the right to take out or withdraw whatever he wants from the business. So we have this thing called the drawings. And it's what owner took up. takes out. Now, you might think that as the owner of a business, he can do anything that he wants to the business. Um, well, that is somewhat true. In accounting, we will always need to look in the perspective of the business. So whatever that enters into the business, whether it's from the owner or whether it's from the bank, it has to be recorded. And whatever that the owner takes out or whatever that flows out from the business has to be recorded as well. So there's this thing called accounting theories. And in POA, there are about 11 or so accounting theories that you need to remember the definitions and how to apply it. So the reason why we need to record equity or specifically capital and drawings is because of this theory called the accounting entity theory, which by definition it says that the business, BS stands for business, and the owner is separate, or rather are two separate entities, is separate from the owner. So when that is the case, we will always have to record whatever that the owner contributes to the business or whatever he takes out from the business, simply because the business is separate from the owner. They are not one entity together. Okay, so you need to also um, remember the definition of accounting entity theory, especially for theory questions and how it's being applied. So a question can ask you, why does the business have to record the capital contributions or drawings? Then you have to say that because of accounting entity theory, which states that the business is separate from the owner and all transactions are recorded from the point of view of the business. Therefore, drawings and capital contributions have to be recorded. So using these two equations, we can solve some questions. Let's try and look at question A then. Right, we have just three elements, and if you recall, we can use the acronym LO. So if you were to substitute the alphabets with the unknown or and numbers, we have this. So L is simply made up of 82,200 minus 43,800. So a little bit of calculation there. Pretty simple mathematics actually. So L here is 38,400. Okay. We can try C. So in this case, C will have A that's missing. So you can leave it there, or you can use the alphabet, the unknown X. And then we have 37,300 plus 64,100. So we will have a total of $101,400. Okay, I think you can try B on your own. Now, what about another kind of question? We have the expanded account equation. So you see more elements here. You have all the 5 elements: assets, liabilities, equity, income, and expenses. So as I mentioned earlier, capital is under equity. We don't have drawings here, just for simplicity's sake. So just try part A. So if you recall, the expanded account equation is made of A equals to L plus OE, or we can use it as sometimes you use it interchangeably. We use capital and equity interchangeably. But equity is actually a very big umbrella, which comprises of, let's just draw it here, okay? Equity is actually made up of 4 things. It's made up of capital plus income minus expenses minus drawings. So that's what equity essentially is all about. So to find what our liabilities, the figure for liabilities here is, we are going to substitute the figures equals to L plus 14,900 plus 6,700 minus 2,600. So if you were to slowly go and figure out what is L, we will have 32,600 minus 14,900 minus 6,700 plus 2,600. That should give us the figure for liabilities. So you get 13,600. Right, I think you can also try for income using the expanded equation. So just to summarize things up, we have the basic accounting equation to write and spell out in full. And from there, we can get the expanded accounting equation. And remember that the reason why we record capital and drawings is because of the accounting entity theory.